2019 looks like it's going to be a really interesting year for the Australian housing market. So in this video, I wanted to give you my thoughts on what's going to happen in 2019. I wanted to talk about some of the positive things coming from a Australian property perspective over the next year, as well as some of the things that you need to be aware of and be careful of. So let's get stuck into it. I suppose let's start with the negative stuff. The first major issue we have in 2019 in Australia from a property perspective is purely sentiment. Now, as you've all seen over the last 12 to 18 months, the media's sort of changed its stance on property, and you've got a lot of the big breakfast shows, a lot of the big news shows, a lot of the big newspapers absolutely smashing Australian property right now. You've got people coming out there on shows like A Current Affair a while back saying that the whole world's going to stop turning and the market's going to fall on its head. And so what happens over time is more and more people continue to absorb the same information from those journalists and news channels, is that sentiment slowly shifts to a more negative sentiment. So like any other marketplace, like the stock market, like the crypto marketplace, like business, for example, or like the economy, sentiment and consumer sentiment is absolutely massive. So going into 2019, I was reading a report yesterday from ME Money. From 12 to 18 months ago until the December 2018 sentiment report from those guys, sentiment has actually improved slightly. I suppose people are sick of hearing the negative stuff constantly after 18 months of getting it rammed down their throat. But people are still cautious, people are sitting on the sidelines, and you'll notice, when average people that know nothing about the economy or property start talking about how negative the property market is, and how bad it's going to be and how much prices are going to jump or drop, then that's a good gauge that we're either close to the top of a marketplace. Think 2 years ago in Sydney or Melbourne, when every man and his dog in Sydney and Melbourne were talking about property and about the money that they were making, and when your average baker's talking about that stuff, the market's cooked. And the opposite is true when the average person is absolutely throwing property or crypto or shares or the economy under the bus, then generally, it seems to be a better time to start thinking about things. So sentiment's the number one thing next year in 2019 that will have an effect on prices, and I think it's going to have a leveling effect. The second thing is we're coming into an election year. Once every 3 to 4 years in Australia, we have a federal election. This is my third election, I think, or fourth election since I've been a property investor. And what I find is that each time we have an election, a lot of people just sit on the sidelines and wait to see what happens, what the result's going to be. They use an election as an excuse. From my study of history in America and Australia, there doesn't seem to be a correlation between what government's in power and the long-term results of the stock market or the property market. They may have a temporary or short-term result on sentiment, but as far as everything else is concerned, most people just get on with their lives and it doesn't really change anything. Think about how big a deal they thought Trump would be in America. He's done nothing except strengthen the economy over there. Unemployment rates are the best that they've been in a long time, and the economy seems to be heading in a semi-positive direction at the moment. Now, the third thing that I think is important is it's still very difficult for some people, just some people, to get access to money. It's very easy if you're a first-time buyer. It's very easy if you've got an okay income or a good business. It's very easy if you've got some equity or some cash in the bank. It's very easy if over the last few years you haven't over-leveraged yourself or gone too hard or borrowed too much money. It's difficult if your income's shit, or you don't have any savings, or you own too many properties, and based on the new borrowing capacity, I suppose, terms or policy, you're just in a position where you can't do anything right now. And there's probably a few investors out there right now that are holding a lot more property than they'd be able to today. But as we all know, money opens up and expands at different times of the property and global financial cycle, and then it becomes tighter at different times. Now, I'm stoked that the Australian government and APRA stepped in 18 months ago and put the brakes on the property speculation that was going on in Australia and Sydney and Melbourne. What I think Australians need to do in 2019 is recognise that Sydney and Melbourne went up by 80 to 100% over the last few years, or 5 or 6 years, where other markets like Brisbane, for example, didn't really do too much on average. In fact, over the last 10 years, it did less than 1% growth per annum. If you look at Perth, it's down about 15 to 20% over the last 7 years. If we look at Darwin, I think it's down about 15 to 25% depending on whose data over the last 7 years. Where Hobart on the other side, like Sydney and Melbourne, has gone through a huge growth cycle in the last 4 years and grown by about 40 to 50%. Now, the problem with grouping Australia as one marketplace is it's very, very dangerous, because all different markets are doing different things at different times. So 2019 is a really good year to begin wrapping your head around where different opportunities lie. Obviously, it's not a year to go out there rushing in and buying Sydney or Melbourne. I still believe that those marketplaces are going to come down. One thing you've got to be aware of in 2019 is I think prices in Sydney and Melbourne are going to come down by somewhere between 5 and 12% again over the next 12 months, which if you bought in the last 2 years is going to hurt. But if you're a long-term investor with a long-term approach, then this is just part of the cycle. Property prices go up, they go flat, and they go down, and you just have to be aware of that. Now, another thing that's happening in the background is America. So Phil Anderson, and there's quite a bit of economic research on this concept of what they call the yield curve, and this yield curve is a pretty good indicator for a recession, effectively. Basically what happens is the daily cash rate in terms of what what the US government or the Federal Reserve Bank is lending people, versus what the 10-year bond rate is, which is, if I was to put my money into a bond right now, this is the guaranteed annual return I'd get back at the end of that term. Now, when there's a nice big buffer between the cash rate, let's say that the cash rate's 2% and the 10-year bond rate's 4%, that's a nice healthy gap, and that, in the history of the US, there's never ever been a recession when the yield curve has been that high. But at different times of the cycle, as you've begun to see in the last 12 months in America, they've increased the official cash rate 3 times. I think it's sitting now at 2.5 or 2.75%, and the 12-year bond rate's coming down as well. And they call that inversion. And when they cross over, historically, America has gone into a recession. Now, a lot of people are talking about America being a bit overcooked. I'm not sure about you, but my super fund is made up of only the S&P 500, and I've made a 67% gain in the last 2 years. Stock markets just don't keep running like that. So I feel like there's a good chance that America will go into a recession over the next couple of years. That's obviously going to have a knock-on effect around the world, and possibly could force Australia into a technical recession for 6 months, 12 months, 18 months. Generally what Phil Anderson and Fred Harrison call this stage that we're going into between 2019 and 2020, maybe 21, is the mid-cycle slowdown. For any of you that have followed their work, Phil Anderson did a book called The Secret Life of Real Estate and Banking, where he looked at 250 years of American property and stock market boom and bust. Fred Harrison wrote a book called The Power in the Land, which looked at 300 years of UK stock market booms and busts and property market booms and busts. And what they both found was this bigger cycle with a lot of accuracy over the last 50 to 70 years in the UK and America in particular. We come into this point, which is predicted to be between 2019 sort of mid and 2020-21 as the mid-cycle slowdown point. A lot of people will freak out as a result of that, unemployment rates could get slightly higher. You know, we could be in a technical recession in America and Australia. But what's important to recognize about the mid-cycle slowdown, as opposed to the top, which is actually more like a GFC or a Great Depression or a recession we had to have, is this concept that not everybody is all in right now. So there's still plenty of people around the world that are just getting over the last GFC. A lot of companies that have just got profitable again in the last few years that have been stacking money in the bank. Companies aren't completely over leveraged right now in property and shares and with employees. Mum and dad investors aren't completely all in all over the world in the stock market plus the property market. So generally what happens is we have this couple of year period which represents a really good buying opportunity. Not so much in stocks until the market corrects itself over the next few years, but in property, what can happen historically is that property prices can sit flat, or like Sydney and Melbourne, they can start coming down a bit. Sometimes they drop by 5% around the world, sometimes they can drop by up to 15-20%, and then we get into the second half of the real estate cycle. So keep an eye out for an American recession. It's just something to be aware of, something that is important to understand, and it will have an effect on Australia. The last thing that I wanted to touch base on, or two things, is obviously there's this conversation around a trade war between America and China. We've just got to watch this space, because if China obviously goes into recession, it could have an effect on Australia in terms of their need for our resources, which is a big part of the reason why Australia is still doing okay. The other thing is obviously a Labor government coming in. After the Labor government just absolutely whitewashed Victoria recently, there's a good chance they're going to get into power, and if they do, there might be a conversation around property, there might be a conversation around negative gearing. We all know that Labor likes to contribute to spending in the economy, they like to do infrastructure, they like to look after schools, hospitals, university, healthcare, all that good stuff that we need. They also like getting us into a huge amount of debt from that spending, but it generally is good for business in one way, just in the sense that they are pumping the economy with money. So we've come out of the mining boom, we then moved into a construction boom, which is ending. Over the next couple of years, you'll hear a lot about infrastructure and the infrastructure boom. And then we'll probably, with commodity prices increasing again, move back into the second half of the cycle, back into a mining slash construction related boom, and that's where the money will flow. And what I can see from talking to clients all over Australia and all over the world, we've got a lot of clients in mining, in resources, in engineering, in infrastructure, is that there's quite a few big projects in pipeline. There's also a number of the mining companies kicking off construction phase again, and also big research and feasibility stages again at the moment. So, you know, these things all just go in cycles, whether it's resources, whether it's property, whether it's shares. Don't freak out over the next 12 months or 2 years about what's going on, which leads me into the positive parts of 2019. Now, 2019 is so fucking exciting to me personally, because I wouldn't describe myself. There's two types of investors. There is the bull that is always optimistic and always looking at the future and always riding the run up, not really expecting the downside, that you know, invests when the world is turning towards the positive. And then there's more like the bear, which a lot less investors are like this, which is the person that comes out in winter time, and the type of investor that shorts markets in the stock market or buys property when it's cheaper or distressed or when sentiment's lower. And I would describe myself more as a bear. I like to take advantage, as Warren Buffett says, of being greedy when others are fearful. I don't like to buy stuff really when everyone else is talking about it, because it's generally not the right time to be buying it when your average mum and dad that doesn't know anything about it's completely all in. So I get excited when people start sitting on the sideline that don't actually understand what's going on, that don't understand the difference between a mid-cycle slowdown and a proper GFC, global recession or depression. I get excited when 25-year-old journalists or 40-year-old journalists who are just broke, cashing in a paycheck and living week to week are absolutely slamming the shit out of property, because it means that the average person that only consumes that content, which is most Australians, are only getting one message. And you know, generally when that message is getting served up, the marketplace has already begun to or currently pricing that message into the market. That's what I love about the stock market. That's what I also like about the property marketplace, is that things that have been turning for literally the last 18 months to 2 years that I follow, like the yield curve, like the number of tallest buildings, like the titles of the movies coming out, for example, like where we're at in the global 18-year cycle, like where the big companies that trade on the stock market that actually rely on the property industry to do well for their profit are at in terms of their positions and their stock prices. Like, there's so many indicators that you can track that give you a much earlier indication of where things are going, and then getting advice from people like Phil Anderson and Fred Harrison, as well as all of the other awesome analysts out there. But you know, it gets me super excited that sentiment is lower, because I believe the next 2 years will represent probably the best buying opportunity in the last decade in Australia in terms of property. Obviously not in Sydney and Melbourne, but definitely in southeast Queensland. The second thing that gets me excited about the next couple of years is, like a lot of you, I've put myself into a position where I've got a bit of money in the bank. I've got a bit of passive income coming in from my properties. I've got a bit of equity that I've created over the last 7 years, and you know, I'm in a position where I can actually go out there and borrow money when other people can't, and so I'm going to definitely use that to my advantage over the next couple of years, and use some of these distressed sales that will come to the market, or some of these people that will freak out, to actually pick up really high quality properties. And we've already begun to see that over the last 5 months. Some of the deals that we've been buying have been fucking amazing. A friend of mine just sent me a text message a couple of days ago. He's like, dude, check out this. It was a 1,200 square metre block that we could chuck 8 units on, walking distance to the beach. You know, a year and a half ago it would have been selling for an extra $800,000. There's just opportunities starting to come around because the buyers for those types of products aren't around, and because money's a bit harder. The other thing I like, when I look at the Heron Todd White report, when I look at Michael Matusik's reports, when I look at CoreLogic or RP Data's stuff and Residex's stuff, the next 5 years look very positive for certain suburbs in southeast Queensland, particularly Brisbane. Another thing that I saw recently, which was interesting, was BIS Strapnell's recent forecast report between 2018 and 2021, and they're forecasting Brisbane, southeast Queensland to be Australia's top performing marketplace over that time. Remember a couple of years ago, or even 12 months ago, everybody was freaking out about the oversupply of inner city units in Brisbane. Michael Matusik's just done an Australia-wide, across all of the capital cities, review of what real supply and real demand look like, and he's basically come out and said that based on his numbers, Brisbane is now the only marketplace in Australia from a unit perspective out of the capitals that is undersupplied, because significantly more people have moved to Brisbane than were expected according to the ABS over the last 18 months. That unit oversupply issue that was supposed to crush the Brisbane market for the next 5 to 7 years, or at least that's what the fucking journos were saying, has been completely absorbed by the market, because more Australians are moving up here into southeast Queensland than any other place in Australia right now. I get excited because Brisbane has sat flat, relatively flat in terms of across the board. Obviously some suburbs have kicked ass, but sat relatively flat for almost 10 years now. If it sits flat for next year and the year after, that would mean 11 or 12 years of almost no growth. I get excited about 2019 because it's the very first year I've had as an investor over the last 10 where I have a completely clear idea of what I want from the properties that I buy moving forward, and that is a clear strategy. And I think that gives me a lot of confidence. It allows me to invest when other people are scared. It allows me to take action when there's blood on the streets and people losing money. So my plan personally is very simple: buy the right market at the right time. That is number one. Buy properties with great potential for long-term capital growth. I've looked at the history of Australia based on Homely's data, and effectively Sydney, Melbourne and Brisbane over the last 50 years have been the three top performing markets by far, all doing an average of over 9.5% per annum. Brisbane doing the highest over the last 50 years at 9.7% of any Australian capital city. That gets me quite excited that the long-term potential is strong. I don't think forecasting into the future that I'm going to get even half of those returns, but if I can get 4.8% compounded on average every year for 15 years, it means my $1 million property is worth $2 million in 15 years. The 15 years after that, it's worth $4 million, etc., etc. So I'm very happy with that. I get excited because people like the Macquarie Bank are saying that 140,000 people from Sydney and Melbourne will cash up, sell out of their properties and move into southeast Queensland and Brisbane, actually just Brisbane, over the next couple of years. Whether that happens or not, I don't know, but that represents a huge transfer of wealth from one area to another, to the point where that would add about an extra 25% of the current demand from a property perspective in the Brisbane market on top of what's already happening. So my plan is to get that long-term growth. I also like to get very strong cash flow. I'm not a believer of losing money to make money. I always need my portfolio to be neutrally geared or positively geared. So the way that I do that personally is to either build dual income properties, which is a property with two incomes, or I buy a house and build a granny flat. Now, everybody's got an opinion on that. You know, you have your opinion, I have mine. That's completely cool. Everybody's got a different strategy. I also acknowledge that. But I want cash flow and capital growth. I don't just want one or the other. The fourth and last thing that I'm always targeting with my strategy, and will target in 2019 and 20, is properties with the potential to add some value in the future. So I've learned now that I don't need to buy below market value to get a great purchase. I used to think it was all about buying a cheaper property or the cheapest property in a good suburb or a good area. But what I realise is cheap properties, even as the market's increased in Sydney and Melbourne, they all increase because the rising tide lifts all the boats, but they increase at a significantly slower rate. And so what might have been a $50,000 difference 15 years ago in Sydney and Melbourne between quality property and cheap property in a suburb, that difference is now $200,000 or $300,000. So rather than chasing a short-term gain of 20 or 30,000 bucks or 50 grand on the way in, I'm always looking to make that extra money over the next 10 to 15 years from buying quality. But I always buy something with the potential to add some value, whether that's a granny flat, whether that's buying an unrenovated house and renovating it in the future, whether that's adding a bedroom and bathroom, or buying something that I can develop down the line. I'm always looking for that upside in my portfolio as well. So I get super excited about the next couple of years. Yes, sentiment's going to be lower. Yes, there are a bunch of people over the next couple of years coming out of interest-only loans under principal and interest. I was reading an update yesterday where my thought process over the next couple of years is that they're actually going to lower interest rates in Australia, or at least the Reserve Bank of Australia is going to lower rates. I think in 2019 there'll be at least one, if not two, rate drops, which represent about 0.5%. Hopefully the banks actually fucking pass these on to investors this time, as opposed to increase them, which they've done. You know, the cash rate in Australia is very, very low, but the interest rates on the properties from the banks are very, very high. or not very high, obviously they're historically low, but they are very high compared to the cash rate. The banks are obviously cleaning up right now and making very, very healthy profits as a result of that. But I like that about the next couple of years as well, because it's all about having a way to get out of things if worst case scenario happens. And one of the ways that we can do that in Australia is the Reserve Bank of Australia can lower the cash rate, which is the rate that banks borrow money at, and then the banks can pass on those reductions. So right now we're sitting in a position where the cash rate's low and interest rates are historically low but a lot higher. That means that, you know, the banks, if people start getting into big trouble for some reason or start defaulting on their loans in a big way, could potentially drop interest rates if we start going through a recession, or property prices drop too far. Like, I think if property prices were to drop by more than 20% from the top of the Sydney market, in either Sydney or Melbourne, I think the Reserve Bank would step in pretty quickly to stop that, or politicians would start priming the economy with money again in some way or another, or put pressure on the Reserve Bank to drop those interest rates. And so that gives me a bit of confidence that, you know, as cheap as rates are right now, the banks could, you know, effectively drop to 2.5% or 3% interest rates to re-stimulate the Australian economy and the Australian property market if things get really bad. So I don't think they're going to be that bad. This is the last thing that I'll finish up the video saying. I've been saying this since 2015, that I thought the Sydney and Melbourne marketplaces would be finished. I said Sydney would be hitting top of market in early 2017 in those videos back in 2015. I said that Melbourne by the middle to the end of 2017 would be at top of market, and they'd both be declining by this year. I also said at the time that I thought the decline would be somewhere between 15 and 25% in both of those markets from top to bottom before they stabilise again. And that would obviously have a carry-on effect throughout the rest of Australia, just in terms of sentiment, like it is. I don't think 25% is realistic anymore. I mean, I know there's other people out there that think the whole world's going to stop turning. Just the tip, it doesn't. We continue to go around the sun, and that's how things happen. The sun is definitely going to rise tomorrow, and in a poor market, or a market where there's no sentiment, they're the markets that represent the best buying opportunities for smart people over the next few years. But I actually think now it's probably going to be more like 15 to 20% drop from top to bottom in Sydney, and somewhere between 15 and 20% drop from top to bottom in Melbourne, although Melbourne's quite a bit more affordable than Sydney is right now, so it might just be a 15% drop from top to bottom. You know, who knows what the fuck's going to happen realistically. These are all just my ideas based on following a lot of analysts for a lot of years and a lot of economists. Time will tell. You'll be able to look at this video in the future and go, Ben, you're a fucking idiot, you had no idea what was going on and you got it all wrong. Or maybe you look back and I look back and go, well, you know, some of those things were right, some of them were wrong. I think 2019 and 20 are going to be special years for smart investors. You just can't go out there anymore and just buy anything and expect it to go up in value like you could have 5 years ago. I think you've got to have a great strategy. You've got to have a nice, healthy cash savings buffer, or refinance some equity so that you've got a cash buffer sitting there. It's certainly not a year to go out there and speculate. It's certainly not a year to go out there and make silly decisions. For some of you, it would be much better to sit on the fence for the next year. For other people that have good cash flow, that have good equity, that have good savings, and that have a healthy job that they can see themselves, or work in a healthy industry that isn't going to be too affected over the next few years. The next couple of years are going to be a fucking amazing buying opportunity for smart people. I can't wait to get into the marketplace again. My brother Simon, who works with me and is my business partner, just bought a property yesterday. He bought it for about 30 grand below market value. And then my sister Crystal also just is refinancing her house at the moment so that she can set up to buy another property next year. I've obviously just gone through the same process of cleaning out my house, sold a couple of properties at the top so that I can go into some cash and just have a nice healthy buffer there, as well as take advantage of current market conditions over the next couple of years. So wherever you're at, obviously invest safely. Talk to your advisors, talk to the people that you trust in your life, your accountants, your financial advisors. Get a bit of a plan in place, get a strategy in place, and obviously always step forward with caution. I love these opportunities personally, because I understand them and because I can see them in advance based on my analysis of history. They don't frighten me like they used to. The next couple of years represent a great opportunity. So for those of you who are thinking about maybe buying a property in Australia in the next couple of years, I'd love to offer you a one-on-one strategy session. Please jump over to my website, www.pumpedonproperty.com, and click the free strategy session button. We offer about 8 to 12 of those sessions a week. We only actually take on 5 new clients a month now. We used to take on 15 to 20, but we've really pulled it back so we can just do great work with a few people and have a very, very personal relationship with them. Our approach is very analytical, very process driven, very data driven. We don't do anything that I'm not doing personally in my world. Our approach is always that capital growth, cash flow, timing the right market, buying the right suburbs, buying the right positions, buying quality, low maintenance, secure property. So jump over there and book that if you'd like. Otherwise, please subscribe to this YouTube channel if you haven't already done it. Please check out our podcast, The Pumped On Property Show, as well. I wish you all the best over the next few years, whether you sit on the sidelines like a lot of people will and wait and see, whether you take advantage of current buying conditions in southeast Queensland, or whether you just, suck it and see for the next few months. And then, I can guarantee you'll look back in a couple of years' time, particularly in Brisbane, and go, fuck, that represented an interesting time. So good luck. I wish you all the best. Stay safe. Don't do anything silly, and keep your finger on the pulse. Make sure you don't overdo it over the next couple of years either. See you guys.